Hi, welcome again, everyone, to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. So today, we're going to be looking at one of the so-called recovery stocks, so International Airlines Group. So they are an airline group business, clues in the name, and they basically have airline businesses, Anglo-Spanish airline businesses, and a few companies that they kind of own, airlines that they own. So Aer Lingus, which is an Irish airline, BA, British Airways, Iberia, Spanish. You also have Level, which is a low-cost airline, and Vueling, which is another low-cost airline. So quite a sizable group. Now, this particular company and video came as a request from one of our viewers. So Derek Smith, with a nice detailed request, gives us a bit of context into why he's interested in a company like this. And don't forget, if you would like us to analyze a company for you, whether you are thinking about investing in them, whether you're thinking about selling your services or products to them, or even if you're thinking if you have an interview coming up with them and you really want to impress them at the interview, do leave a note in the comment section. Tell us why you're interested in this company, and we will do our best to analyze and post this video for you. But don't forget to subscribe, especially because as a subscriber, you will instantly get notification when we post this video. So make things easier for you. Before we go into the finances of this company, just a quick note on the share price, just so that you can get a rounded view on this business. Floated in 1988, and as you'll see later on, so stick around. You know, it's a wild ride. So either, you know, as a value investor, you'd probably be very worried, but as a day trader, this could be a dream for you because of the fluctuation. So in the last 5 years, if you invested 5 years ago, your investment would see a drop of 53%, so not insignificant. However, in the last year, it's up by 7%. So again, as I said, day trader, this is probably a good one for you. So we'll cover that in a moment. Quick note about the finances, especially if you're looking at this video for your investment thesis. We're not here to help you forecast the future, right? There's a whole other amount of research that's involved in your investment thesis. This is one part, albeit it's a very important part. But the purpose of this show and these episodes are not to help you with your investments necessarily. We are here to help raise the understanding and knowledge of how to analyze finances and learn the language of business. As Warren Buffett says, finance is the language of business. So if you're involved in business and you can't understand the language, well, you can't do anything really much with it. So that is the whole point of these videos. It is to help educate people on how to better understand, read, and analyze financial statements so that you are a lot savvier in your discussions. So with that introduction, Ted, please take it away. Let's share with our viewers what we've analyzed about this company.
Yeah, thank you very much, Moeed. Good to see you again. Yeah, interesting comment about the day traders. I don't think we'll have any day traders in our subscribers. So if you are a day trader and you're watching this, I'd be very interested to know as to what you get from the analysis of the financial statements, because you don't care if a company is going to go bust next week. You're in and out by tea time. So here we are. This is IAG. This is their annual report for 2020. So they haven't produced the 2021 yet. We're still early days. And so we are now on page 143 of a 230-page document. So all of the previous 142 pages will explain, you know, how tough life has been and how they are kind of, you know, got corporate governance and ready to weather the storm. But we're just going to be looking at the numbers. So here are the numbers. We start off with their income statement. Now, if you were under any suspicion that the airline industry did not really get impacted by the pandemic, let me put that to bed. 25 billion, 26 billion of sales in 2019 drops to about 8 billion of sales in 2020. This is a massive drop. Now you'll notice cargo revenue actually went up. So suddenly we're all sitting at home ordering stuff online, click, click, click. And so they see an increase in their cargo, but look at the passenger revenue. I mean, it just fell off a cliff as we would expect. So really, really, really tough times for the airline industry. So what are they doing about it? Well, look at the costs. Now, again, you'll notice here, we see this in some companies, they don't talk in terms of cost of sales. And the reason these guys don't talk in cost of sales is that they're selling a service. They're selling the ability to get you from A to B. And if you think about it, it costs pretty much the same to fly a full aeroplane as it does an empty aeroplane. So what they don't talk about cost of sales, what they really just look at is the operating costs. And that is this section here. And they give you things like these. So the employee costs dropped significantly. There'll be a lot of furlough going on in there, probably some redundancy as well. So a little bit of restructuring. The oil and fuel costs. Well, of course, if you've got grounded aeroplanes, you're not spending so much on fuel. The catering costs will fall, but a lot of that will be, fixed contracts that they still have to, meet their obligations. So we're not seeing the similar kind of 70% reduction that we see at the revenue. So a fixed cost business, if the revenue goes down, the fixed costs don't necessarily go down in the same kind of proportion. And then there's, engineering costs dropped a little bit. So the sum total is that their costs have dropped a little bit, but the revenue has dropped very, very dramatically. And that means that they are now in an operating loss as opposed to an operating profit in the previous year. So tough times for IAG. Just really very, very tough times indeed. They've still got to pay their financing costs. So they've got debt sitting on the balance sheet and you still have to be able to pay that. Now, traditionally, we would compare that interest to the operating profit and say, yes, absolutely fine. Things are fine here. But of course, this is not a sustainable in the long term. So these guys really need the world to reopen up to us to get back on those airplanes and to start traveling. Now, to what extent are we going to see that come back with, the world of Zoom and conference calls? Obviously the travel is going to come back up. People want to travel for, to see loved ones. They want to travel for holidays. Business travel will come back. The question is it going to come back to the extent that we've seen it in the past? And quite frankly, it'd be quite nice to see people like certainly BA be a little bit more flexible to encourage that travel, maybe by making it easier to change your booking or to get a refund if you don't want to fly for whatever reason. Anyway, that's a personal thing. So tax rebate during the year and bottom line is a loss. So 7 billion loss from a 1.7 billion profit. So not massively profitable. That's, that's a 7% profit margin in the previous years, but a massive loss in 2020. And hopefully 2021 we'll see a kind of, it's not going to be a massive rebound. There's still going to be losses in there, but hopefully they're going to be clawing their way back to profitability. Let's go and have a look at the balance sheet and see the strength of the company that sits behind these numbers. So here is the balance sheet. The non-current assets up at the top, property, plant and equipment, that's going to be aeroplanes, funnily enough, and some intangible assets. So this will be goodwill, where AIG has been buying, various airline companies. And those are really kind of mainly the non-current assets of these guys. In terms of the current assets, things which we own and either are cash or going to become cash soon, really stuffed with cash. So lots and lots of cash. So reasonably sort of strong on the balance sheet, lots and lots of cash. You see trade receivables is pretty small, but that's because you pay for your airline ticket before you board the flight. And again, it was reasonably high in previous years, but still, relatively speaking, a pretty small number. So lots and lots of cash sitting on the balance sheet to help them kind of fight their way through. This is obviously the end of 2020 to help them fight their way through 2021 as well. Let's look at the bottom half of the balance sheet where the liabilities and the equity are. So in terms of the liabilities, borrowings, so there's the short-term or current borrowings and the long-term borrowing. So they do have a reasonable amount of debt sitting on the balance sheet. And we also see, so this is deferred revenue. This is just people who've bought flights, but they haven't yet taken them. So, quite big numbers there for 2020. And that'll be a lot of the kind of the vouchers that they've issued and the promise that, people can fly in the future. So again, good for their cash flow. But even when it becomes a sale, all they're doing is that they're just cashing in vouchers, and it doesn't help their cash flow when the people actually travel. So again, cash flow is going to be really crucial for these guys, which is why they need to make sure that they are sitting on lots of cash. The equity up here, they've really taken that big hit, and the big hit is because of the revenue. So the loss, they've made a massive loss, and therefore their retained profit is now a retained loss. And you'll also notice this share premium account has increased. That means that they did a rights issue. So they will have raised money by issuing shares, as well as borrowing a bit more money. So the borrowing has come up there, the increase in these numbers, and the share premium has come up. So they've raised money. So that cash that they're sitting on, some of that will be from raising money by issuing shares and borrowing more money. So the sum total of the balance sheet. So first of all, we notice if I just scroll up a little bit, we can see our current. I can't quite get it onto the same page here actually, but if you just remember, so the current liabilities down the bottom, that's 11.5 billion. That's this number down here. So this is money that we have to pay soon, and the current assets are up at the top. So you can see them. Actually, maybe I can get it almost on the same page. So the current assets up here is that 7.8 billion. So in a traditional business, we kind of say, oh, we don't like that. That looks a low liquidity ratio. But a lot of their current liability is this deferred income. And also because of the nature of the business, you pay for the flight and then you fly and then they pay the costs. Very strong cash flow will allow airlines to operate on, effectively a liquidity ratio of less than 1. So point to realize here is that certain businesses can operate with current assets less than current liabilities, airlines being one, telcos, supermarkets. However, if you don't have money in working capital, the lower your liquidity ratio, the more problems it causes when things like pandemics come along. So strength of companies, sometimes we like to have that kind of that rainy day account. BA didn't, or IAG didn't have that rainy day account, and therefore as a result of the pandemic they had to tap the shareholders. They had to say, look, we need some money in order to survive this, otherwise we are going to go out of business. So let's keep going. Here is, we'll come on to the cash flow in a minute. Let's just look at the changes in equity. So the previous year, here's the previous year, you'll notice these guys. So the profit for the year, there's the profit, 1.7 billion, and they are paying out a small amount of dividend, which I just need to scroll down a little bit to see that dividend. So yeah, there's the dividend they're paying out, and the dividend is about 1.3 billion. So a lot of people would have been invested in these guys thinking nice solid dividend payers, and then of course the pandemic comes along and there's going to be no dividend at all. So suddenly, not only is there no dividend coming out of this business, but we could also see there's the rights issue down the bottom. So they're raising additional money by issuing shares. And then we come back to the cash flow. So here's our cash flow. So as we'd expect, as a result of that pandemic, negative cash flow, really, really tough. So there's the loss. There's the depreciation, which is being added back, and they have got negative cash flow in spite of the fact that they're sitting on lots of deferred revenue. Scrolling down a little bit further, we look at the investment. Now, in terms of the investment, we need to be quite careful here. So just spot these numbers here. So this is increase or decrease in interest-bearing deposits. Now that is not investment in a financial sense. That's not CapEx. Okay, this up here, this is CapEx, and that's also selling off some stuff. So we need to kind of eliminate this number here from our calculation. And I'll just highlight that. If we go back up to the balance sheet, when we talk about how much cash they've got, you'll notice that I circled this number down here. In fact, if we're going to talk about how much cash they've got, we need to circle these top two numbers. And so you'll see in the previous year, they had some interest bearing, effectively bonds, which is basically like savings for these guys, and some cash. And they basically had to, they've sold. If you take this number here, this 2.6 billion, this is their rainy day account. They've sold their rainy day account in order to raise money in order to keep the business alive. And that's effectively what's been going on there. So obviously they've sold it. They can't do that again. So on a net basis, their investment is about 804 billion. So, and they've scaled back investment, obviously, in order to survive. And then we see in the financing, this final bit, the proceeds from, so typically proceeds from borrowing, repayment of borrowings. So there's a little bit of refinancing going on, but mainly the debt is increasing. They're increasing their debt. They've basically eliminated their dividend. They've reduced it completely, and there's the money coming in from the rights issue from issuing more shares. So where does that leave us? Well, obviously 2020 is quite a long time ago, and we've still got the whole of 2021 which they've been through, and 2021 will have been, it won't be as dire as 2020, but it will still be pretty tough. So we'd expect them to produce a pretty horrible set of numbers, and then hopefully in 2022 they can start to kind of return to normal. But even if they return to normal, there's a lot of costs in this business. They don't make a huge amount of profit. 2019 it was only a 1.7 billion profit. So as you mentioned, Moeed, it's quite a roller coaster, maybe good for the day traders, but not good for the long-term investors. Their market cap is 7.75 billion. So just to put that into context, there's obviously there's no PE ratio because there's no earnings. There's no dividend yield because there's no dividend. But they are trading. If we compare that to their book value, for example, then they are, their book value, their net asset value 1.3 billion. So they're on 7.8 billion. So what's that? That's nearly kind of 5 times their book value. Which is not cheap. If they were to return to 2019 with 2 billion of or 1.7 billion of profit, then that would be a pretty reasonable number to buy in at. But again, the jury's out. What's going to happen to the airline industry going forward. So if we look at this kind of, we look at the kind of the trading range, they hit this kind of this bottom. And every time they hit the bottom, they bounce back up again. So they hit the bottom, they up, and this is kind of, they're kind of, so there's, what it says is that there's a resistance. Okay, every time they hit the bottom, they kind of trade up. There's the kind of there's the reaction to the pandemic, and then everyone's buying it, and then suddenly they realize actually airline stocks, no, we do not want airline stocks. And again, so you get this resistance here. So they're not far off that resistance line. So, it kind of says to me, there's wiggle room for these guys to kind of bounce back up again. It may not be a straight line, but it looks to me like, maybe, if you look at sort of past performance, you might want to kind of, hold on, buy the investment, hold on, ride the kind of waves up and down, and then cash out, when they're up at sort of 400, for example, which they've been at before. And there's nothing to say that they won't get there again. But that's that's not based on any kind of sound financial logic. That's just based on trading patterns. So not something which is a kind of reflection of the analysis that we've been doing here. So there you go, Moeed. There's my kind of analysis of AIG. Am I an investor? No, I'm not. It looks tough times at airlines. And I think, they've got to do everything they can to persuade people, to get back on those airplanes, just make it as easy as possible for them, beat the other airlines, provide the best service, and open up the world. But they aren't really at the mercy of governments around the world, and their desire just to lock down countries, cities, and overnight.
Really interesting. And don't forget, just as a point, when you're looking at the market cap versus the net asset value, just remember that the financial statement for IAG is in euros, whereas their share price is in the UK market. So there will be a bit of a currency conversion there. But yeah, really interesting to see that. Particularly interesting to see that support line. Actually, it's almost a perfect bounce every time. So I think if we do have any day traders or people who are familiar with the support lines and Fibonacci lines, etc., they might be interested in looking at that. So it could be an opportunity. But yeah, it looks like time and again, especially if you're selling to a company like this, you've got to really think about, where does your expense fall under? Is it capex or opex? And that is going to have a very different reaction with different companies, especially a company like IAG, where they'll be very capex heavy in some respects. So yeah, very interesting analysis. Love to hear everyone's comments. If there's someone who is an expert and very knowledgeable in this industry, would love to hear your thoughts. Share it with the rest of the community. We're here to help everyone raise their financial knowledge and education. So until the next video, thank you, Ted. Thank you, everyone else. And we'll see you soon.
Catch you later, Moe.